Imagine an ordinary Saturday morning. You wake up, make coffee, turn on the computer, and decide to check the balance of your bank account. And suddenly you see that almost half of your money has simply disappeared, evaporated. No, this is not a cyber attack, not hackers from the dark web, not a banking system error. This was done by your own government together with the bank, where you kept the savings of your entire life. It sounds like the plot of a dystopian film, but for hundreds of thousands of residents of Cyprus in March 2013, this became reality. And the most frightening part is that this can happen again to you no matter where you live. The story began several years earlier. Cyprus, a small island paradise in the Mediterranean Sea, had turned into one of Europe's largest offshore financial centers. Its banking sector swelled to unbelievable proportions. The assets of Cypriot banks were 7 times larger than the gross domestic product of the entire country. Cypriot banks, especially 2 giants, Laiki Bank and Bank of Cyprus, aggressively lent to the Greek economy and bought Greek government bonds. This seemed like a great idea. High interest rates and a reliable European borrower. Then the year 2010 arrived and Greece plunged into a debt crisis. When Greek debt was restructured in 2012, bondholders lost more than 50% of their investments. Cypriot banks suffered catastrophic losses. By the beginning of 2013, the 2 largest banks needed around 10 billion euros to survive, an astronomical sum for an economy with a gross domestic product of only 17 billion euros. Cyprus turned to the European Central Bank, the European Commission, and the International Monetary Fund for help. Negotiations were difficult. The European Union and the International Monetary Fund agreed to provide assistance, but under harsh conditions. And among these conditions was a demand that shocked the entire world: bail-in, rescuing banks at the expense of the depositors themselves. On the night from Friday the 15th of March to Saturday the 16th of March 2013, the Cypriot authorities announced a stability tax on the banking system. 6.75% from accounts up to 100,000 euros and 9.9% from accounts above that amount. The money would be written off automatically. Panic began. People rushed to cash machines, but the banks were urgently closed. Electronic transfers were frozen. Cash machines were quickly emptied. Lines stretched for hundreds of meters. People shouted, cried, demanded explanations. The police were placed on high alert. After several days of chaos and heated debates in Parliament, an even harsher plan was developed. Depositors with balances below 100,000 euros were exempted from write-offs, but those with more suffered catastrophically. Holders of large deposits at the Bank of Cyprus lost 47.5% of their funds, almost half. This money was forcibly converted into shares of an almost bankrupt bank. Depositors of Laiki Bank suffered even more. All deposits above 100,000 euros were completely destroyed. Banks remained closed for 2 weeks. When they reopened, draconian restrictions were introduced: a maximum of 300 euros in cash per day, foreign transfers prohibited, checks could not be cashed, and deposits could not be closed early. These restrictions lasted for months. The Cypriot economy contracted by 10%. Unemployment jumped from 12% to 17%. Behind every percentage stood real human tragedies: an elderly couple who sold their house in the United Kingdom and placed all the money, 500,000 euros, into a Cypriot account lost almost 250,000 overnight. The owner of a construction company with 300,000 euros in an account for salaries and purchases lost half and was forced to shut down the business, laying off all employees. The official version claimed that this was fair. Wealthy depositors, especially foreigners, had used Cyprus as a tax haven. But reality was harsher. Most of those affected were ordinary people: Cypriot families, pensioners, and small businesses who lost money earned through honest labor. The Cypriot crisis was not an accident. It was a planned operation, the first large-scale application of a new doctrine that financial regulators began developing after the global crisis of 2008. To understand why, let us return to the year 2008. When Lehman Brothers collapsed, governments around the world began rescuing banks. This was called bailout, external rescue. The United States injected $700 billion, the United Kingdom nationalized banks, and Europe provided guarantees worth trillions of euros. This stopped the collapse, but created a huge problem. Ordinary people saw blatant injustice. Bankers had received multi-million bonuses for years while risking other people's money. And when their bets failed, the losses were shifted onto taxpayers. Profits were privatized, losses were socialized. This triggered a wave of protests: the Occupy Wall Street movement in the United States and mass demonstrations in Europe. Politicians understood that this could not happen again. Society would not forgive another bailout. A different approach was needed. This is how the concept of bail-in was born. If a bank collapses, those who consciously invested money in it should pay: shareholders, bondholders, and large depositors. In 2014, the European Union adopted the BRRD directive, which made bail an official policy. The United States adopted similar rules. How does this work? There's a clear hierarchy, a loss cascade. The first to be hit are the bank's shareholders. Their shares are completely wiped out. Next come holders of subordinated bonds, then senior unsecured bonds, then other unsecured creditors. Only after all these categories does the turn reach depositors, but not all depositors at once. There is a deposit insurance system. In Europe, deposits up to 100,000 euros are insured. In the United States, up to $250,000. Anything above that falls under bail-in and can be written off partially or completely. Does this sound fair? But the devil is in the details. Not everyone with more than 100,000 is a millionaire. These can be entrepreneurs with money for salaries, families who sold an apartment, pensioners who saved for old age. For them, losing even half is a catastrophe. Ordinary depositors do not have real access to information about a bank's condition. Financial statements can look excellent until a multi-billion hole is suddenly revealed. It is enough to recall Silicon Valley Bank in the United States, which looked reliable on Wednesday and collapsed on Friday. After Cyprus, bail-in was applied several more times. In 2015, HEDA, Asset Resolution in Austria, was liquidated, and bondholders lost billions. In 2016, 4 Italian banks were restructured, thousands of private investors lost their savings, and some committed suicide out of despair. The year 2017 brought new examples. Spain, as Banco Popular, was sold for €1 after shareholders and bondholders lost 1.3 billion euros. 2 Italian banks, Veneto, went through bail-in, destroying creditors' funds. Authorities repeat, small depositors are protected, but this protection has a critical flaw. Deposit insurance systems usually cover only 1% to 2% of all deposits in the banking system. If a large bank collapses, or several banks at once, there will simply not be enough money in the fund. What then? Theory says that the state will recapitalize the fund. But that is again a bailout, exactly what the authorities want to avoid. The reality is this: if a large-scale crisis occurs, the insurance system will not withstand it, and all depositors will come under attack. Moreover, the digital economy creates a new threat: the speed of panic. In the past, it took days for information to spread. Now, a few tweets are enough, and millions will start moving money through online banking within hours. This is exactly what happened with Silicon Valley Bank. In March 2023, depositors withdrew $42 billion in one day. That is why regulators have received new powers to instantly freeze accounts, impose limits on cash withdrawals, and ban electronic transfers. All of this can happen over a weekend, and you will only find out on Monday. Bail-in has turned from theory into a real instrument that will be used more and more often. The global financial system today is in a state that many economists consider more dangerous than before the crisis of 2008. Global debt has reached $307 trillion, more than 350% of global gross domestic product. Before 2008, this was about 280%. We did not solve the debt problem, we made it worse. Central banks printed trillions, kept interest rates at zero, and created gigantic bubbles everywhere. Real estate, stocks, bonds. Then inflation began, and rates were sharply raised. The United States Federal Reserve raised the rate from 0% to 5.5% in a year and a half, the fastest increase in 40 years. This created enormous pressure on the system. Which countries are in the risk zone? Italy is a bomb at the heart of the Eurozone with debt at 145% of gross domestic product and a weak banking system. Germany, Deutsche Bank, is balancing on the edge with derivatives worth 40 trillion euros, 12 times the country's gross domestic product. China faces a real estate crisis, defaults of Evergrande and Country Garden, and bad loans in banks. Japan has debt of 260% of gross domestic product, more than $10 trillion. The United States, in March 2023, 3 large regional banks collapsed in 3 days: Silicon Valley Bank, Signature Bank, and Silvergate Bank. This was bail-in action. The problem of American regional banks is that they hold trillions in bonds bought when rates were zero. Now their value has fallen by 30 to 40%. These are unrecognized losses that can materialize at any moment. How can you understand that your bank is in danger? A sharp fall in the bank's share price, if the drop is 20 to 30% in a few days, the market senses trouble. Growth of credit, default swap, spreads, insurance against bankruptcy, negative news about large losses, bad loans, departures of top managers, technical problems with online banking. Sometimes this is a way to slow the outflow of deposits. But the main thing is insider behavior. If top managers massively sell shares or move personal accounts to other banks, this is a red flag. The problem is that when these signals become obvious to everyone, it is usually already too late. Bail-in happens on weekends. On Friday evening, you go to sleep with your money. On Monday, it is already gone. What should be done? First, diversification. Distribute funds among several banks, preferably in different countries. Make sure that in each one, your deposit does not exceed the insurance threshold. 100,000 euros in Europe, $250,000 in the United States. Second, alternative assets. Physical gold is a centuries proven store of value. Real estate is illiquid, but it will not be written off overnight. Shares of reliable companies are real assets, not just numbers in a bank. Cryptocurrencies are debatable, but they are decentralized and harder to confiscate, although extremely volatile. Third, cash at home. When a crisis begins, automated teller machines empty within hours, cards stop working. Keep cash for at least several months of basic expenses in different places. Fourth, monitoring. Follow the news, especially on Friday. If a crisis is brewing, act immediately. You may not have time until Monday. Cypriot depositors who withdrew money on Friday saved their savings. The rest lost half. Fifth, legal preparation. Study your country's laws on bank bankruptcy and bail-in. Understand your rights. Sometimes pension accounts are better protected. Deposits in the names of different family members may have separate insurance limits. But the most important thing is to understand the new reality. Your bank deposits are no longer unconditionally safe. Legally, when you put money in a bank, you give it a loan. You become a creditor, and creditors bear losses in bankruptcy. Bail-in has become official policy in all developed countries. This is written into law. The financial system is overloaded with debt, inflated by bubbles, and dependent on constant injections of new money. When the music stops, under the new rules, depositors will pay. Cyprus in 2013 was a general rehearsal. The authorities tested the mechanism and refined the procedures. Next time, they will act faster, harsher, and on a larger scale. Financial crises occur roughly once a decade. 2008 was 16 years ago. We are in the risk zone. The trigger could be a sovereign default, the bankruptcy of a systemically important bank, a geopolitical shock, or a cyber attack. And when this happens, you may wake up and discover that your money has disappeared, not because you were careless, but because these are the new rules. Bail-in is a reality you will have to live with. The question is, will you be ready? Will you have a plan? Will your assets be diversified? Or will you find yourself standing in line at a closed bank with empty hands, like those thousands of people in Cyprus? The choice is yours. But remember, when panic begins, it will be too late. The time to act is now, while the system is stable. Because next time, the scale will be larger, the time shorter, and the consequences more severe. A banking run 2.0 is not fantasy. It is the future that is already knocking at the door.